And still the markets are looking to avoid danger, and what they saw in the Greek story was not the story of a small country. Greece is only 2% of the European GDP. But they saw the danger of a default that would spread to larger countries and larger institutions, which would then have ramifying effects in terms of confidence of the holders of the stock of those bonds, or who were investors in those insurance companies, that would cause them to pull, causing those stocks to drop, causing more problems, causing those those institutions to potentially begin to fail and default on their creditors. And you can imagine, this is the concept of contagion. Now, the cynicism of some parts of the markets, however, is such that contagion is an opportunity for profit. And so in the spring of last year, what we found was that about 24 hedge funds in New York had begun to buy shorts or credit default swaps on Greek bonds, thinking that, well, in fact, Greece is in terrible trouble, the Europeans won't rally to help it, these bonds are going to sink lower, and we're going to short-side the bonds, and we're going to make a killing. But of course, the news that those bonds are being shorted, of course, does what? Fuels more fear, which in fact pushes the bonds down further, making Greece's financing problems more difficult, making the risk of contagion even greater. And I'll tell you a secret. We use the reality of those hedge funds buying Greek bonds, or buying short positions on Greek bonds, as part of the tale that the Greek government used to rally European support in May of last year, so that Greece got a $150 billion loan package. The Germans held their nose at their annoyance with the reprobate Greeks because they were so damn angry that the American